Welcome into the reaction channel, folks. Few things to discuss in this one here today. First off, I made a big move in the public count here today, sold out of 45% of a position. So we're going to go through what position that was, why I went ahead and did it here today, okay? Then I want to react to this video from a few hours ago. Nvidia stumbles amid market rally. I think this is important video, subject to speak about. Nvidia stock is actually down in the past 6 months, which is actually pretty fascinating considering how good their earnings are. So we're going to speak about what I think is going on there and kind of talk about if I actually believe Nvidia is an opportunity here or not, okay? Then we're going to get into this one. Apple stock surges to a record high, which is pretty crazy because Apple's earnings are trash. Like, they're not good right now if you compare them versus somebody like Nvidia, but yet this stock just continues to move up and move up, right? So we'll talk a little bit about that. Then I want to react to this one. Stocks will continue to rally in 2025, it says this individual from Deutsche Bank. And then last one here, Julian Emanuel from Evercore ISI. He unveiled his bullish 2025 outlook, but warns investors they should brace for early year setbacks. So I think that's going to be a fun one to react to. Appreciate everybody joining me as always. Busy, action-packed reaction video here today, folks. All I need from you, one thing only, smash that thumbs up button. Make sure you subscribe to the channel here. If you want to be subscribed, we just hit a new all-time high subscribers in the history of this channel. We're on the path to 100,000 subscribers on this channel someday. So I appreciate you all for being here. Pin comment down there today if you're looking to apply to join my private stock group and get access to all my best course curriculums, so you can learn everything I got up here. If you want access to 1000x stocks, if you want access to my private Discord chat, all that good stuff, pin comment down there, okay? Alrighty, so what I went ahead and sold out of here today, and we'll speak about why I went ahead and did this. Well, it wasn't clearly a sellout. By the way, I think this is worth mentioning, okay? It's been a year of winning. I had Travis Hunter for Heisman, baby, $6,000 winner chicken dinner. They paid it out to me yesterday. I'm rich now, baby. Okay, thank you, Travis Hunter, for coming through on that one. So what I went ahead and sold out of here today, well once again, 45% of the position I sold out of is toll put option. So this is something I had on in for a hedge in the portfolio, right? But what's interesting with toll is, I've opened up this position kind of recently, right? The first contracts I bought October 2nd, then I bought some more October 15th, November 12th, and December 9th, right? But toll's been going down pretty rapidly here recently. So next thing you know, I found myself up $13,000 plus on this position in a pretty short amount of time and on a pretty small position, right? Up 44%. So I said, let me go ahead and cash out 5 of the 11 contracts here. So that's what I went ahead and did here today. I got $40 a piece for those, right? So not bad. And so I thought, let's go ahead and kind of de-risk a little bit here. I'm going to keep the other 6 contracts for now and kind of see what happens with toll. But this stock has been weakening quite considerably, and it's fascinating because it's not like the market's bad right now, right? And so I will say in regards to toll, if this market were to get much worse, I think this thing could get ugly really quickly here, which is, it happens with toll over time. But I mean, you look at the stock just since, you can kind of look around like Thanksgiving time, right? And the stock is down, 20 plus percent in just the past few weeks. Like, that's like basically like a 3-week chart I have up here for you guys. And it's down, 21%. So it's been going down rapidly. The earnings were not bad. The conference call was not bad. The company had, it was actually pretty decent. But I think there's a belief that overall toll's backlog is going to start to dry up more and more as the year ticks on. Maybe that's reality, maybe it's not. I'm seeing, like I told you guys, when I was going to make this hedge, is I'm definitely seeing more and more inventory on the higher end of the market. When we're talking $1 million plus, those sorts of homes, I'm seeing in almost every big city that toll participates in, all the big dog cities like that really sell a lot of those $1 million plus homes. I'm telling you, like, they're seeing heavy inventory start to pile up in those sorts of brackets. And so I just, it makes for a tough backdrop for toll. So the other ones I'm going to keep on here for a bit, but I mean, if toll keeps sinking, next thing you know, the stock's 120, 115, I wouldn't mind just getting out of the other contracts as well and taking my profit and running. Like I always tell you guys with these hedges, I don't need to hold them all the way till expiration. Like, if something happens in between expiration and me holding that position, it's not, you got to treat the hedges very differently than you treat a long position. So on a long position, let's say I'm adding to AMD stock, right? Which actually is a stock I'm adding to right now, right? So let's say I buy AMD stock. I don't need to, if AMD goes from let's say I buy shares at 125 and it goes to 135, 145, means nothing to me because I'm in AMD because I believe it'll be a $300, $400, $500 stock. So if it goes from 125 to 145, it means nothing. Like, okay, made money, but it's like, you know, a very small amount compared to what I believe the potential is over time. Hedges, especially if you're talking about put options, you got a finite amount of time, right? I got till September 2025 with this. If I can make a ton of money in the short term and just get out of it, sometimes it just makes sense to get out of it. If it's a huge profit there, right? Like, I don't need to push my luck closer and closer to that expiration if I get an opportunity to make a huge profit early on the hedge, right? So that's the way I personally look at it. And always remember, I hedge multiple ways. I'll hedge through put options, like something like this with Toll Brothers here. But additionally, I hedge with cash. I always keep a pretty significant amount of cash around. So then, any corrections in the market, any drama, crashes, things like that, I'm obviously in a position to take advantage of those opportunities as well. So that's why I went ahead and did this here today. Like I said, if Toll tanks more, next thing you know, the stock's 120, 115, don't be surprised if I get out of the hedge completely. But for now, I'm just going to hold these other 6 contracts, and they're a nice kind of diversification hedge to the public account, right? Because we know if this market gets ugly, like, where do I see Toll Brothers stock going if the market got ugly? What do I mean by the market ugly? I mean the market ugly, like, let's say S&P 500 all of a sudden drops like 20%, right? Where's Toll Brothers in that? Toll Brothers stock in that is probably $70, maybe lower than $70. So that's why, a Toll Brothers can be a pretty good hedge because, I mean, if the market gets ugly at all, a stock like that just gets obliterated. Like, no one wants to own home builders if the stock market starts to tank. It's always been the way it is and still going to be the way it's going to be. Like, if the market gets shaky, no one wants to be in home builder stocks. When the market's going up, when people feel good about the economy and all these sorts of things, like, people don't mind owning the whole home builders. But man, as soon as things turn the other way, people are quick to run out of those, right? And so, yeah, it's interesting, right? Alrighty, let's react to Nvidia here because this is a fascinating one. Nvidia stock, for those of you who don't know, is actually negative now on a 6-month basis. On a 6-month basis, Nvidia stock is down. Really, really fascinating. So let's go ahead. Oh, actually, let me go ahead and pull up valuation here with Nvidia. So just before we react to the video, I just want to show you guys valuation here. 32 forward P, reality is probably 29. 2-year forward P is 29. Reality is probably going to come in at 25 or 27. So not crazy valuation metrics at all, especially considering the growth rates of Nvidia. Like, at this point in time, Nvidia's growth is going to have to stall. Well, we'll speak about that a little bit more in just a moment here, but let's react to this.
10% from a closing high in early November. Joining us now is John Vinn, KeyBank equity research analyst. I like the way you approach this, John. It almost reminds me of a Ben Franklin close. You've got everything I could possibly use here. You got a bull case. You give me what your bullish fiscal year 26 earnings per share estimate is and what a premium multiple would look like, and then you give me the reasons why. And you've also got a bear case with a lower multiple and a much lower earnings per share estimate. So nobody really knows, and you've given me a lot of reasons for both. What you finally come to, though, is that you're overweight the stock with a price target of 180. Let's go over some of the bull and bear case. The latest earnings was pretty solid, and so was the outlook.
Yeah, that's correct. These guys continue to put up numbers that are above expectations. You see continued upward revisions in estimates. They're on the verge of kind of ramping a new generation product called Blackwell, which is going to give, provide them with kind of a step function uplift in terms of kind of the pricing that they're going to get, and also just the performance in AI trading for their customers.
And you give a lot of good reasons. It's going to continue to outstrip competition for GPUs and AI. If the company were able to earn $5.30, your high-end estimate, and you put 38 times that, you could get to $200, although you've got a 180 price target. Let's talk about the bear case, because no one ever really, we don't hear that much. But if it instead of $5.30, you think the downside possible earnings per share miss would be 350, and if
So, if you're wondering, is Nvidia a buy here? I mean, you can make a pretty strong argument that Nvidia is a buy, especially now trading. Today it was trading 120s. I mean, you could actually make an argument that it's a buy. I thought Nvidia would exit this year somewhere between 150 low end, probably more toward 200. The fact that it's down here, given the multiple on the stock, what needs to happen in order for Nvidia not to be a moneymaker over the next few years is Nvidia's revenue growth has to completely come to a standstill, right? Like completely to a standstill, where all of a sudden their revenue just flatlines completely. Like if their revenue completely flatlines in 26, 27, then Nvidia stock's not going to be a moneymaker, over the next couple of years. But if Nvidia just continues to grow revenue, even if it's at a slower clip, given the price it's at right now, it could actually be a moneymaker over the next few years. Now, is it going to be the moneymaker it was in the past? No, absolutely not. This is not like some crazy 10x opportunity from here. This is more like if you're thinking about 50% appreciation maybe over the next few years, that's a potential for Nvidia here. But yeah, I mean, it's been fascinating to watch a lot of people actually really pile out of the stock. I was a little early on kind of in my move out of the stock, and I wasn't expecting this many people to be moving out additionally, right?
29 times on that, you're all the way down to 100. So you can get to a range of 100 to 200 on what's fair value. What goes into the bear case?
Yeah, there's a couple things that's driving the bear case, and probably a little bit what's driving kind of the more recent pullback that you see in the stock is two things, right? These guys are dominant in terms of their market share in the market. They probably have kind of 85, 90% share. So if you are a customer of Nvidia, you've got two alternatives right now, right? You can buy another merchant solution from, probably the second biggest merchant provider of AI silicon is probably going to be AMD, or you can kind of build your own, like Google has with its TPU. So, I think what's driving some of the recent concerns is Broadcom reported last week. They've got three major customers right now that they're working with to build AI chips, right? It's Google, it's ByteDance in China, and it's Meta. And they put out a SAM forecast of 60 to 90 billion in fiscal 27, which would imply that their AI revenues are going to quadruple in 3 years. So if you kind of do the math, that would imply that is potential share loss at the expense of Nvidia, right? So that would be some of the concerns that's driving kind of the near-term pullback in Nvidia that we're seeing right now.
You've got the possibility of eventually not being, I guess, the only game in town. But when you take everything into account, you still think it's a good buy here at under $130.
Yeah, the important thing people got to understand about, because this is always talked about, Amazon has their own chips, and Meta has their own chips, and Google has their own chips, and all these companies have their own chips. Like, why are they doing so much business with Nvidia? Why are they getting down and begging Jensen, please give me as many chips as possible? Why do you think they're doing that? Because Nvidia's got the best chips. Nvidia has the best tech platform. So these other companies, which many of them I own, including Amazon's a major investment of mine, and obviously Meta's my biggest investment in the public account, over $1 million position, right? I would love it if those companies could just do exactly what Nvidia does, but it's not realistic. They can't. So therefore, Nvidia's always got the best chips in the market in this space, and so you kind of always need Nvidia, right? That's just the way it is. And so Nvidia can continue to grow while these other players continue to make their own chips, right? And use companies like Broadcom and others and ARM, right, to make their own chips. But, there's a false assumption like it's a zero-sum game. One loses, one wins, and that's it. No.
Yes, absolutely. I would say, a couple things, right? One, we're far from being a zero-sum game right now, right? The AI market is growing well north of 100%. It's probably going to grow, 60, 70% in 26. So you've got massive growth in the overall TAM. You've got multiple winners here, including Nvidia, Marvell, and Broadcom are all going to benefit. I think AMD is making some good progress there, but with the launch of Blackwell, this is a pretty big step function up in performance. So we think they're going to maintain pretty dominant share in the merchant market. On the custom AI side, right, where, a Broadcom and a Marvell are going to come in, obviously they've got big customers who are investing a lot of R&D dollars into building their own AI chips, but there's a little bit of uncertainty there, other than Google right now, and maybe AWS to some extent with Trainium. There's a little bit of uncertainty in terms of whether a hyperscaler or another AI provider can be successful building their own AI chips.
So, I'm obviously buying AMD heavily right now. I believe AMD's risk-reward profile for the next 3 years is vastly superior to Nvidia. That's my belief on what I understand about this industry and where the valuations are at, and the sort of ramp AMD should have over the next 3 years versus Nvidia, right? So, and AMD's now going into a growth cycle in terms of revenue acceleration year after year after year for the next many years, where Nvidia is now in a revenue growth deceleration cycle for the next several years, right? But what somebody could do here if they want to kind of hedge their bet on AMD is somebody could actually do something very similar to what I've done with Celsius and Monster here, right? So let's say you believe AMD has a lot more upside for the next, 3-5 years, whatever, than Nvidia. You could make AMD your bigger position, but you could hedge by essentially buying Nvidia as well, right? So you could put like $2 in AMD for every $1 that goes into Nvidia. It's a very similar strategy that I've done recently with 2 stocks. Those stocks are Celsius and Monster, right? I wanted to build out a position in Celsius, but then I said, well, you know what? Celsius has a lot of upside potential over the next few years, but it also comes with more risk. So let me mitigate some of that risk by going ahead and buying Monster, the biggest player in the energy drink space. That's a public company, right? So that's what I went ahead and did. And so there could easily be an approach kind of like that, where essentially somebody invests like $2 in AMD for every $1 they do in Nvidia. And then if they really want to hedge even more, they could essentially do $2 in AMD, $1 in Nvidia, $1 in Avago, right? And then you really cover all your bases here. And then Avago has maybe the most exciting earnings per share growth story over this next bit of time, right? The next few years. So that's a way of hedging as well. It just comes with a much bigger valuation, right? 2-year forward P on Avago looks like it's around 36. Broadcom. And they acquired Avago a while back, so that's why they have the ticker symbol AVGO. And then AMD, 22. So that's also a potential. My guess is next year revenue growth, my guess is Broadcom's significantly above where analysts are at here. And I think that's probably something else that's exciting people in regards to Avago here. So yeah, that's that. All right, let's talk about Apple.
Most overbought company right now in the S&P 500 with a relative...
Wow, the most overbought company in the S&P 500. Woo-wee!
Index, RSI, something Josh talks about all the time, of 92. It's posted 25 all-time closing highs so far this year. The question is, Josh, if that's something that you look at and tell our viewers to pay attention to in the way we should think about what to do with stocks, what do I do with that?
The message of Apple is whenever Warren Buffett is selling something, you want to be buying with both hands. JK, love you, Warren. All right, what's going on here is absolutely remarkable. They obviously had a product cycle this year with the new phone. Did not get the critics to be blown away by any of the stuff they did. They're slowly rolling out AI features. They put like this image playground app on my phone yesterday. Fine, I guess I'll try it. The iOS 18 refresh was a disaster. I heard the All-In guys trashing that last week. It really just hasn't been a great year for headlines at Apple, but the fundamentals remain so powerful. I think it was enough for this stock to continue to be accumulated. It also doesn't hurt that we're shattering every record on the books for ETF inflows. Apple's in every ETF. It's in the dividend ETF. It's in the shareholder yield ETF, buyback ETF. They're a leader in CapEx. They're a leader in R&D. It's in the tech ETF. It's in every index. Dow, S&P, Nasdaq, XLK. So when you have money pouring into ETFs, and this is the largest or second largest holding throughout the course of the year, plus the buyback, like it's not crazy to understand why this thing has been melting up. I don't think at a 92 RSI, it's a great purchase. So I'm not like adding to it, but would I sell it with a gun to my head? I probably still wouldn't. So I think a lot of people are where I am with this stock, and that's just what it is.
So you read it more of a potential bad sign of getting in or buying more, but not necessarily a bad sign that you need to worry about it turning down because it's so overbought.
If you own it for the last, I'm in this stock literally forever. I can't even tell you what price it would have to get to for me to feel it. So I wouldn't be shocked if we saw a 10% correction in Apple to start off the year as money rotates. Keep in mind, the RIA channel is $7 trillion. Do you know what RIAs do in January? Okay, they rebalance. Any form of rebalancing at any large wealth management organization is going to involve selling Apple. You have to understand that. If you don't understand that, you don't work on Wall Street, you don't belong here. So 100% you're going to see selling come out in this name, but how extreme is that selling really going to be? Are people like walking away from the stock? Absolutely not. So you have to be willing to endure that correction if and when it happens, if you're going to be long this name. And so most people are.
Carrie, client calls you up later, right? And it's like, look, I was watching halftime.
So let's be very, very crystal clear here around Apple. The stock is not moving on anything fundamental. There's nothing exciting going on with the company, right? As a super big Apple customer and shareholder on and off for many, many years, there's nothing going on. This is probably the most disappointing time I've ever seen for Apple, bar none. I was actually on a Saturday, I was at the mall, what was that, last weekend or so? And my kids wanted to go in the Apple store, play video games for a minute while we were waiting for my wife at another store. So I was like, okay, that's fine. We're in there. This place is a ghost town. It's December on a Saturday at the busiest mall. And there's a ghost town in that store. There's no excitement around anything Apple related right now. I mean, nothing has excitement around Apple. And this is one of the very few times I've ever seen where Apple doesn't have something. Like, I still remember the days when like the Apple stores were buzzing, man. It was like a can of sardines to get in there because people were so excited to try new products and see what they were about, right? And it's just like, oh man, like the excitement back in those days was crazy. And if you were around back then, you remember going to the mall and the Apple store would just be a club, man. It was like a club in there. It was like you wanted to get by people, you need to go like this because it was just mobbed. People waiting outside to get in, just crazy, right? Those days are long, long, long gone from Apple now, right? And so now they're basically just a company that tries to make every product that they have just a little bit better so they can keep people just kind of upgraded and keep them in the ecosystem. And it's a fine business model, right? But let's be very crystal clear. There's nothing fundamental that's moving that stock at all. A lot of it just has to do with flows of money, where it's positioned in the market, those sorts of things.
I saw you guys talking about Apple being so overbought. Stock's been up, and I'm up a lot in it. What are we doing about it? What should we do about it?
Yeah, well, I think that there are a couple of important factors. One is, what's the tax hit? And many of our clients are taxable most. They care about paying capital gains. Stocks like Apple, it doesn't matter where we bought it. It's all a big gain right now. So to the extent that people say, oh, we thought it was a 4% position and now it's a 5.5%. I understand the rebalancing point that Josh brought up, but also there is the tax hit. And I honestly think that since most people are underweight these names, they are underweight Apple, and the idea now to continue to be underweight is less attractive because the rest of the market has done so little for people.
I mean, to give you an idea of what we're talking about, Steph, right? You don't own Apple anymore.
No.
But at 92, for a stock like Amazon, which I think is more like 77-ish.
Had a nice run, yeah.
It's an incredible run, but it's not 92.
No.
But how do I think about the types of overbought stocks and what I want to do with them as we approach the end of the year and make the turn?
Well, as you know, I sold Apple because I made 40% in 4 months' time, and I didn't think, and I still don't think, that this version of the iPhone is going to be the super cycle from AI. I definitely think in the out years it will be, but next year I think it might struggle, and I think it's ahead of itself, and I took some gains. But what I did do as a portfolio manager, since I'm underweight, a 7% weighting in the S&P 500, I made Amazon huge. It's a huge position, my largest by far, so that if it does participate, if it does outperform, I'm not going to get hit by being quote unquote short Apple because I don't own any Apple against my bench. So it's a little technical, but quite frankly, I like Apple. Amazon much better than Apple because I think there's a lot of ways that they can win. Yep. It's retail, they're taking share. It's AWS, we all know about the cloud, and it's accelerating. Advertising never gets talked about. They have huge amount of cash. I think they're going to announce some sort of a dividend or a bigger buyback. And yeah, it's expensive at 35 times, but it's at 14 times EBITDA, and historically it's traded at 17 to 18 times. And so I still think there's upside. I still want to own the behemoth in the discretionary sector.
Is this sign for you of the excess that you were talking about when you see something as overbought as the data team says that Apple now is?
No, because we don't sell things on technicals. We buy and sell on fundamentals, Scott. And
the fundamentals are behind this move higher, as we said?
Well, I think what's behind this move higher, quite frankly, is liquidity. I think people are chasing liquidity at the end of the year because they, quite frankly, don't know what else to do, so they're continuing to own these big stocks, number one. Number two, there's a difference between owning and trading. We're not traders, we're owners. We've owned the stock on behalf of our BMO clients for 12 years. I think this is a juggernaut. And so when there's two rules to Apple.
Can go up with lack of, fundamentals behind it. Are you telling me there's fundamentals behind the last 13% in a month?
I think there's fundamentals to owning this stock. And it's cash. They have more cash on the balance sheet than several developed countries. Number two, they're buying back stock. Number three, they're paying dividends. Number four, you can make a value component to this. You can buy a growth component. And lastly, here's the rule to Apple. Never bet against the U.S. consumer and never bet against Apple. Period.
Mic drop. All right. See, I knew I'd get you going.
So you can actually bet against Apple. It's a hard thing to do. I've done it a little bit, and it's done bad and done good in the past. So now, in terms of Apple, let's take a peek at the valuation. Okay, let's take a peek at this valuation in regards to Apple. So forward P on this one is close to 34. Woo-wee! I mean, yeah, rich. When you talk about a stock that has current year expected earnings per share shrink, right? Or maybe slight growth. We'll see where the numbers end up shaking out. If you look at current year expected revenue growth, 3%, I mean, you're talking about really, really bad numbers. But there might be excitement about revenue growth acceleration next year, and that's fair, right? But there's no doubt that the stock is richly priced, but that doesn't mean it can't go to 300 in the short term. So, it's tough. It's tough. And I would be somewhat tempted to bet against this one. But I need to see this Nasdaq roll heavy into the end of the year. And I'd love to see Apple go like 275 into end of year. If that happens, maybe Apple makes sense as a hedge come January to bet against. Because then there might be some opportunity there. So, potential. We'll see. It's a tough one to bet against. There's no doubt. It's Apple, right? And it's just it benefits from just money being forced into it. You're the biggest weight in the S&P 500. Like so much of people's retirement money. Think about all the tens of millions of people that every week or every 2 weeks they get paid, and a certain portion of their paycheck just goes into the 401k S&P 500 index fund or whatever it is, right? And who benefits the most from that? It's Apple. It's Apple. It's always Apple. And so that's what makes, and then you got the big share buyback on top. Like Apple's always got tens of billions of dollars of share buyback going on. So it's just a crazy amount. They're just buying back shares. And that's what makes Apple such a hard stock to bet against. It's not like it's hard to bet against because the fundamentals are so amazing. No, it's because so much forced money is always in that stock, and the buybacks are crazy. And so it helps the stock's price stay a lot higher than the reality than it should be. Okay, stock will continue to rally in 2025.
but it still gained 27% this year. So can it keep going? My next guest says yes. He has the third highest price target on the street in 2025 at 7K flat. Joining me on set is Binky Chadha. He's the chief market strategist at Deutsche Bank. So Wells went to 7.
Wells of 707. Come on, Wells Fargo. Are you serious?
And 7. This is like the Price is Right. I'd love to know what the difference is or how they get to that granularity. But broadly speaking, why do you think stocks can keep rising with valuations where they are and so forth?
Sure. What I would say, at the sort of highest above ground level perspective, equities are really about the business cycle. I would say the business cycle is going really, really strong. If you take one very simple measure of the economic context, so it's low unemployment, but also at the same time, very strong GDP growth. We've averaged almost 3% for 2 years now, and unemployment is still in the vicinity of 4%. And you look back at history, you will see that this almost never happens. It's happened 6% of the time, and I think the times that it happened previously is very telling. So the first time was for 4 years, from 1965 to 1969. And for those of us who aren't well versed in US American history, that was, what many historians call basically economic nirvana. You have 3 to 4% GDP growth, 3 to 4% real productivity growth. You have basically inflation falling, 3 to 4% real wage growth, reflecting the productivity increases. And the second time it happened is in the 90s. But on both times equities did extremely well.
But that's what I was. So in the 1960s, we all think of that period as one of dramatic social upheaval. So I think the economics gets overlooked. But
exactly.
So the market did quite well during that period of time.
It did extremely well for a long time.
Because the previous analogies many people are referencing are the stretches in the 90s and even in the 1920s. Where we've had years of back-to-back 20% gains. Both of those ended up with spectacular crashes. So your analogy to the 60s maybe gives us some hope, does it, that we can kind of experience these kind of gains without there being a hangover effect?
So the way I think about it is, there's a cycle, and we are at a certain stage in the cycle where I would argue a number of factors, sort of coming together. So for now, I would say the cycle continues. I would say the cycle stays basically pretty strong. I mean, another very simple way of thinking about things, there's very little doubt that basically equities have risen very, very strongly. We are up, basically for 2 years in a row in a very tight trend channel. It's going up at 24% a year. So it will obviously slow or break at some point. But I would argue, and you're absolutely right. This is not a common or frequent occurrence. It's only happened basically in the last 100 years, 4 times before, where you have sort of 2 back-to-back 20% years. But again, that's really sort of a
Yeah, so in terms of my opinion on kind of the markets in general there, I think this video I put out yesterday, right, is very, very helpful. I put that on the main channel, Financial Education, for those of you guys that don't follow it. I'm sure most of you guys do follow that channel as well. But, I put a very in-depth 44-minute video together for you guys yesterday on exactly what I think is going to transpire in this market going into 2025 and kind of the flip that will happen and those sorts of things. So if you want a lot of my more in-depth analysis on where I believe the overall market's going, definitely watch that video. That will help you out pretty immensely there. Let's get into Julian Emanuel.
To be here.
So the warning is beware January, because it's not going to be a straight line higher.
So I wouldn't call this irrational exuberance, but we've seen there are pockets of exuberance. The Conference Board survey actually showed the highest reading ever of people that think stock prices are going to be higher a year from now. That's the kind of cautionary, and just for reference, the formerly highest reading was the beginning of 2018, and there's been a lot of discussion of 2018.
So what he's saying here, stocks could fall 8 to 13% early next year. So what he's likely saying there is the S&P 500 could fall 8 to 13%. So, if you get, what's the midpoint there, 10.5%? If you get a 10.5% fall in the S&P 500, keep in mind for a lot of actual individual stocks, we could be talking about 15 to 30% downside, right? So just a little food for thought in regards to that. Cites high valuations, Trump policy uncertainty, plans to buy weakness. What's he talking about 2018 here? I love when we talk about 2018. I love it.
It's the beginning of 2018, and there's been a lot of discussion of 2018. And when you think about the policy backdrop of the incoming Trump administration, it's pretty easy to make the case that we're going to get a little bit of volatility to start the year.
That's wild, because in that 44-minute video, at one point in that video, I brought up 2018, remember? I brought up 2018 and started talking about that a little bit. That's fascinating.
That is exactly what Lori was talking about, 2018 being the comparison year. What's your price target, Lori?
So we're at 6,600. We also
Okay.
have a bear case of 57.75, and it's it's interesting. There's as much interest in my bear case as there is my target, just because I do think there is a lot of nervousness about sentiment. There's a lot of nervousness about valuation, but that runs counter, to the strong animal spirits economic upgrades that we're seeing.
So I would just say, and this is a positive, that clients are very, very focused and very concerned about valuation. And as all of us sit around here, I dare say we have been nervous about valuation, all of us, probably for the last 6 months. Valuation alone doesn't end the bull market, but what it does is it makes it susceptible to any sort of less than perfect news, which the amount of geopolitics that we have going on, and what happens if someone says, Fed Chair Powell, do you think there's any scenario in which you might hike interest rates next year? Mm-hmm. How that question gets answered on Wednesday is going to be pretty informative.
Dan?
Yeah, so we have the fateful 8 here now.
What happens if someone says, which, the amount of geopolitics that we have doesn't end the bull market, but doesn't end on Wednesday.
So I love that there's a lot of clients there that are talking about valuation. That means people are more focused on being a little more sophisticated in the market, right? If you don't really know about valuation, you don't know how to make that case that maybe you're overvalued or something like that, then you're not really very in tune with the market, right?
Going to be pretty informative.
Dan?
Yeah, so we have the fateful 8 here now. Broadcom just add this thing. It's trending. Does it worry you a little bit that those 8 stocks are about 20% of the S&P 500? I know we've been talking about concentration, but if you're talking about valuation, they're also a really important component of the S&P 500 valuation. We've seen massive multiple expansion. They're about 40% of the S&P 500. So 20 trillion, 8 stocks, 40% of the S&P 500 that are making up a lot of the expected growth in the index next year.
It's definitely a concern, and we all know there's one stock in particular that's had an incredible run-up since the election. It is now trading over 200 times earnings, and I dare say that that's a consideration and a worry no matter what. But again, it's one of these things where if you think about it, I think we were all amazed when, say, the top 5 stocks in the weighting in the S&P 500 rose beyond the Y2K peak. And think about how long ago and how many index points ago that was. Again, it's a question of you need other things. And it's in our mind, it's going to be, potentially irrational exuberance. We think the capital markets will show the way towards that if we get there, or a recession, which we just don't see in 2025.
Yeah, in terms of Tesla, right, you might ask, is that one I'm interested? I bet against Tesla before and made a lot of money on it, not nearly as much as I've made from the long side, right? But with this one just being, I think in the last 3 months it's up 100% or something crazy, up another 3-something% today, 106% in the past 3 months. Holy smokers, this ain't no dang jokers. Would it be interesting in going against Tesla again? Yes, but I don't feel comfortable quite yet. I need to see, in order for Tesla to start moving down, we got to get out of this Goldilocks period we're in, or this honeymoon phase, this honeymoon phase. Once we start to exit from this honeymoon phase, Trump is actually in office, right? The excitement over that, it's all happens, right? At that point in time, I could start being a little more intrigued about maybe opening up a put option position against Tesla. But the thing that gives me a little caution here is right now you still have the story being really exciting around Tesla, right? It's the second biggest position for me in the public count. It's doing tremendous, but it has a lot of story going on behind it right now. Additionally, on the fundamental side, we're looking at gross margins that are likely going to be increasing quite a bit in 25 versus 24. We're looking at likely net margins increasing in 25 versus 24, right? We're looking at likely revenue acceleration. So it makes Tesla actually a pretty hard stock to bet against in the short term, right? And that's why I'm having some pause to thinking about betting against Tesla and opening up a put position. It makes sense to hedge against Tesla at some point in time, but it's hard right now. There's too much story there. There's too much margin story, robo-taxi story, revenue story. So that makes it difficult to bet against it right now. There will be a time again when it will make sense to bet against Tesla and to hedge against Tesla, but right now it's a difficult thing to make, other than, well, the stock's extremely rich. Listen, man, Tesla always trades really rich. Like, even when Tesla stock is in a crash period, even when Tesla stock's down big, people still say Tesla's really expensive because it's just the way it is. It is always expensive, right? 155 forward P on it, 2-year forward P 132, right? You could say even if Tesla comes in with better numbers than expected, what's the forward P? 140, 2-year forward P 110. Like, regardless, it's really extraordinarily high. So, yeah, there will be a time to bet against Tesla again. It's just I have a hard time making the case right now, other than the stock's gone up a lot and the forward P is really high. That's not enough. You got to have a little more than that. You got to have the story deteriorate. You got to have everything go back to fundamentals, and then you can at least start to talk about a potential of a hedge position against Tesla. But yeah, right now it's difficult, man. Really, really difficult.
U.S. exceptionalism has been the story for years now. Dollar at some point is a problem. Rates at some point could be a problem, but haven't really been so far. What do you think about the rest of the world? We know their politics in Europe are kind of scary right now, but it's been a lot of underperformance.
We are getting a ton of questions about the rest of the world. It started about really right at the election, because the assumption is in an America First president, you'd see more of this kind of performance, which you have seen. From our point of view, again, here, valuation relative or absolute, it's very difficult to just make the case that it's going to work on the basis of that. We would want to see, in Europe, a reasonably defined dollar top, which is something to certainly look out for. That may be driven by Trump's displeasure. You remember he got uncomfortable about the strong dollar during the first administration. In China, we'd really want to see bond yields stop declining. It looks very much like what you saw in Japan in the 1990s in terms of yields going lower than you could ever imagine. And then as far as Japan, what we want to see is sort of a separation between the way the Nikkei trades and the way the yen trades. And we think that's possible. It worked throughout the 1980s. But again, all of these are catalysts that we're waiting for the macro backdrop to change. And we do anticipate getting more positive on the rest of the world at some point.
Yeah, I just don't think you need to mess around with the rest of the world. I really don't, right? There's so much, just with the U.S. markets, there's so much you have opportunities to. There's so many great companies you have the ability to own, right? There's so many great companies that are undervalued in the U.S. markets. There's good opportunities from the hedging side, right? If you need to bet against some stocks in the U.S. market, like I feel 0% need to mess around with anything international. There's so much opportunity always just in the U.S. markets that I'm like, it's a waste of time. And just because an index trades cheap on a forward P basis or a trailing 12-month PE basis or whatever, it means nothing. It could trade cheap like that for 10, 20, 30, 40 years. Like the Chinese stock market has looked cheap since I started investing 16 years ago. It's looked cheap. 16 years ago. It still looks cheap to this day. It's just the way that market trades, and it's trash. Like you look at the Shanghai index, right? And that index has done nothing for like ever. I don't know if it'll pull up Shanghai composite. Maybe this will pull up here. No, this isn't properly pulling up. If I go to CNBC, I think I can pull it up here. Hold on just a moment. Here we go. I pulled up an all-time chart here for Shanghai. So back in 2007, the Shanghai Composite was 5,500. Here we are, 17 years later, and it's at 3,300. This is, shortly after I got involved in the stock market, right? I got involved at the very end of 2008 and got more involved in 2009, right? And back in those times, the Shanghai Composite was a little under 3,000 and then was at about 3,200, 3,100. It's at 3,300 now. Like, imagine if I had just been putting money in the Shanghai index all these years. Like, oh my gosh, would that be bad? And it's just brutal. So that's why I'm like, you could go through a lot of these indexes, man, they just perform horrible over 10, 20-year spans. If you can't perform well over a 10, 20-year span, there's no point. There's no point at that point, right? So, yeah, guys, I already appreciate you joining me as always. Thanks so much for being here, folks. If you're looking to apply to join my private stock group, get access to 1000xstocks.com, get access to my private Discord chat, all that good stuff bundled together. Pin comment down there, fill out a form, see if we can get you access to all that a little later on this week. Much love and have a great day.